Welcome back to the Deep Dive. We're here to help you cut through the noise, taking source material and pulling out the strategy, the numbers, the insights you really need.
Yeah, get you up to speed quickly.
Exactly. And today, well, we're diving into a big one. Intercontinental Exchange, or ICE. We're looking at their latest results and some pretty massive strategic bets they're making on future tech.
It's a fascinating story, really, because you've got two things happening at once. On one hand, Q3 2025 was a record quarter, best year to date in their history, actually.
Okay, so financially, very strong.
Extremely, but that's only half of it. The other half is how they're using that strength to invest pretty ambitiously, I'd say, in potentially disruptive technologies like AI and blockchain.
Right, let's nail down that financial foundation first. What are the headline numbers?
Okay, so adjusted diluted EPS, that hit $1.71, which is up 10% year over year. Solid growth.
10%, okay. And revenue?
Net revenues came in at $2.4 billion for the quarter.
So a really strong base. And you mentioned this gives them room to maneuver.
Precisely. They talk about building an all-weather platform. And key to that, really, the engine, is their recurring revenue. That was up 5% this quarter.
That recurring piece gives them stability, right?
Yeah.
Predictability, even when markets get choppy.
Exactly. It smooths things out.
Okay, so let's unpack how the core business has built that foundation, starting with the biggest piece, the exchange segment.
Right, the exchange segment. Huge numbers here. Net revenues of $1.3 billion.
Wow.
Yeah. And within that, the recurring revenue piece thing, data feeds, connectivity that hit a record $389 million. That's up 7% from last year.
And what drove that 7%?
A big chunk was the exchange data and connectivity services themselves. Those were up 9%.
And you can sort of see the wider economy reflected in their numbers too, can't you? Like people using their tools for risk management.
Oh, absolutely. Look at open interest. That's the number of active contracts across futures and options. It surged 16% year over year.
16%? And any particular hotspots?
Well, yeah, it's pretty clear what people are worried about. Interest rate futures, open interest climbed 37%.
37%. Okay, so that tells a story about market anxiety right there.
Definitely. It shows where the hedging activity is focused.
Meanwhile, switching gears slightly within exchanges, the NYSE listings business, they seem to be playing a quality game there, leading the market in IPO proceeds.
They did. Raised $20 billion in new IPO proceeds through Q3 2025. Market leading. But here's the interesting part, the strategy behind it.
Go on.
They maintain really high listing standards. The source material mentioned only about half of the companies wanting to list actually met the NYSE standards during that period.
So they're being selective. Why does that matter?
Because it reinforces the value of the NYSE brand. Being listed there means something. And that selectivity, well, it directly feeds into their, frankly, amazing 99% retention rate for listed companies.
Ah, okay. So quality attracts quality and keeps it there. Makes sense.
Yep. Quality over sheer quantity.
Okay. Moving from trading to data infrastructure. Fixed income and data services, FIDS. How did that segment do?
Another record, $618 million in revenue. Recurring revenue here also grew nicely, up 7%.
And is there anything sort of accelerating within FIDS?
Yes, actually. This is interesting. The data and network technology part of FIDS saw revenues jump 10% in the quarter.
10%? Wasn't it lower before?
It was. It was 7% growth in the first half of the year. So this is a definite acceleration.
Yeah.
And it seems to be driven by, well, higher demand for their IC global network.
Why the increased demand?
It looks like clients are getting ready. They're tooling up, preparing to integrate AI into their trading workflows, and they need the robust data infrastructure to do it.
Okay, so this is actually tangible proof. AI isn't just some future concept for them. It's driving external revenue growth now through data demand.
Exactly. It's already happening. And don't forget their index business, also booming, hit a record $754 billion in ETF assets under management, benchmark to their indexes.
Wow. Okay, let's round out the core business review with mortgage technology, MT. How did that look?
Revenues were $528 million. That's up 4% year over year. A bit slower growth than the others, maybe, but still positive.
And what drove that growth?
Mostly transaction revenues, which were up 12%. And the source mentioned specifically Encompass closed loans and MERS registrations.
Okay, let's quickly break those down for the listener. Encompass is?
Encompass is their big loan origination system. It's how lenders start the whole mortgage process.
Yeah.
Huge platform.
Got it. And MERS.
MERS is the electronic registry. Basically, it tracks who owns the servicing rights for mortgages. Think of it as like the essential digital plumbing for the mortgage industry. So growth there means more activity flowing through their core systems.
Right. They did flag a competitive issue, though, didn't they? PennyMac potentially rolling off their platform.
They did mention that, but they also put it in context. It's expected to impact recurring revenue, but only by about 0.5 percentage point. And importantly, not until 2028.
So manageable and still years away.
Seems that way. And meanwhile, the segment actually had its best sales quarter of the year. They signed up 16 new clients for Encompass, so they're still winning business, locking in future revenue.
Okay, so summing up the core business picture, very healthy, generating lots of cash, returning a good chunk to shareholders, what was it, $674 million in Q3?
Yeah, and they paid down debt, too, by $175 million. Plus, their guidance for Q4 expenses looks pretty disciplined, around $1 billion.
So a stable, cash-generating machine.
Absolutely. Which brings us neatly to the next part of the story, what they're doing with all that financial firepower.
Right, the big strategic bets. Let's start with the internal one. AI, and this thing called IC Aurora.
Yeah, I see Aurora. They frame this not as some sudden jump into AI, but more as a natural evolution of their 25-year journey in automation.
So less about flashy chatbots, more about efficiency and insights.
Exactly. Driving efficiency in how they operate and creating better analytical insights from their data. They see it leveraging 3 key strengths they already have.
Which are
Okay, first, their deep knowledge of complex financial workflows. They know how this stuff works inside out. Second, their data. Highly differentiated proprietary data, which, importantly, they think will become even more valuable as AI takes off.
Okay, expertise and data. What's the third?
Network effects. They already connect so many players in the market, AI can enhance those connections.
They even have a scale for measuring this automation, right? 0 to 5.
They do. 0 is totally manual, 5 is fully automated, even handles exceptions. But, and this is a big but in finance.
Accuracy, regulation.
Precisely. AI models are, probabilistic. They give you a likelihood, not necessarily a certainty. So ICE has to constantly balance the business need for automation against the potential risk and the regulatory tolerance for error.
So if the AI isn't, say, 99.9% sure about something critical, a human has to step in, especially in regulated areas.
That's basically it. They set confidence thresholds. If the AI's confidence is below that line, it flags the issue for human review. It's risk management, first and foremost.
Can we see this in action? Any examples?
Yeah, they give a couple of good ones. First, data processing. In their reference data business, think processing prospectuses for fixed income.
Okay, mountains of complex documents.
Right. AI is now processing about 40,000 of those per month, and it's achieving over 95% accuracy in extracting the key information.
And the ones below 95%.
Flagged for manual review. It's that balance. A huge efficiency gain, but with a safety net.
Okay, that's impressive volume. What's the second example?
This one is pretty stunning, actually. It's about modernizing their systems. They're replatforming their big MSP mortgage servicing system.
Taking it off the old mainframe computer.
Exactly. A massive job. We're talking 30 million lines of code. The original estimate to do this, 7 years.
7 years. It's a huge project.
Huge. But now, using AI tools, things like GitHub Copilot, other AI code conversion tech, they've slashed that timeline. They reckon they can now do it in about 2 years.
Wait, from 7 years down to 2?
Yeah.
That's incredible. Why is that specific speed up such a big deal?
Think about it. It means they can modernize, add new features, integrate new tech 5 years sooner than planned. It fundamentally changes the competitive timeline for their entire mortgage tech division. It helps shift MSP from just being a system of record to becoming a system of intelligence much faster.
And customers are seeing benefits already.
Apparently so. They mentioned MSP customers are already seeing cost savings on servicing, maybe 20–30%. And the future plan isn't just basic chatbots. They're aiming for intelligent virtual agents that can actually do things, like schedule a payment for a borrower.
Okay, so that's the internal AI revolution. Now let's shift to the big external bet, the huge investment in Polymarket.
Right. This was a major move in October 2025, a $1.0 billion investment in Blocketize, the company behind Polymarket.
$1 billion. How did they fund that?
Primarily through commercial paper, interestingly, which suggests they're pretty confident about the returns or the strategic value, and they have capacity to invest up to another $1 billion.
What's the strategic play here? Is it just about getting into prediction markets?
That's part of it, but it's broader. 2 main angles. First, data. They signed a strategic data agreement,
Yeah.
meaning ICE becomes a global distributor for Polymarket's unique data. This is real-time probability data on non-sports events, think elections, economic indicators, policy decisions. It's a new, potentially valuable data set for traders looking for an edge.
Okay, data is one angle. What's the other, deeper angle? Sounds like it involves the underlying tech.
Exactly. It's about the blockchain technology Polymarket uses. It enables things that are very attractive to a company like ICE, which runs massive clearinghouses,
Like what?
like 24/7 availability, instant margin calls, instant trade liquidations, all built on smart contracts and a novel banking infrastructure.
And ICE wants to bring their ideas into traditional finance, specifically clearing.
That seems to be the goal. They want to take learnings from Polymarket to enhance their own regulated clearing operations, specifically their ICE risk model too.
How would that 24/7 blockchain-style operation actually help in, say, reducing risk or cost in their clearinghouses?
It's fundamentally about collateral efficiency. Think about when stock settlement moved from T+2 to T+1.
Right. Trade settled a day faster.
And what happened? Trading volumes often increased because capital collateral wasn't tied up for as long. ICE sees a similar potential here. If they can use blockchain-inspired tech to enable capital to move 2147 instantly.
Then less collateral needs to be parked idly overnight or over weekends.
Exactly. It minimizes the total amount of collateral required globally across their clearing members. That freed up liquidity can then fuel more trading activity. It makes the whole system more efficient.
Interesting. And there's a regulatory angle, too. Polymarket pushing the boundaries forces a conversation.
That seems to be ICE's view. Polymarket lists new prediction markets very quickly. ICE believes this kind of innovation forces regulators, particularly in the US, to think about how to reduce burdens on innovators, which could ultimately benefit the entire financial system by allowing new products to come to market faster.
Okay, so let's wrap this up. This deep dive really shows a company firing on all cylinders in its core, business exchanges, data, mortgage tech, generating significant cash.
Right, building that solid foundation.
And then using that foundation to make these two really significant future-focused bets. One inward, using AI with ICE Aurora to revolutionize their own workflows, like that incredible code conversion speed up.
Yeah, boosting internal efficiency dramatically.
And one outward, the Polymarket investment, looking at blockchain for clearing efficiency and tapping into totally new data streams.
Exactly. Two distinct but complementary strategic thrusts.
So for you, the listener, what's the absolute core takeaway here?
I think it boils down to the exploding value of data, specifically proprietary, clean data in this age of AI, especially in a regulated space like finance. IC's deep data assets are what underpins both their internal AI success and the strategic logic of distributing Polymarket's data. Data is the fuel.
Which leads us to our final thought for you to chew on. If this idea of 247 collateral movement, potentially using tokenized assets inspired by Polymarket, really can unlock significant capital efficiency and boost trading volumes in clearinghouses.
Yeah, if it proves out.
Could this rewiring of the financial rails, so to speak, force the big regulated banks and financial firms to adopt blockchain-like technologies much faster than anyone currently expects? Will the sheer technological efficiency start to outweigh the traditional regulatory caution?
That's the billion-dollar question, isn't it? Keep a close eye on how regulators respond over the next year or so. That will tell us a lot.
It certainly will. Thanks for diving deep with us today. We'll catch you on the next one.